Good evening. This is Ken at Tortoise Capital with a review of the daily quiz for February 5th, 2019. So today we're taking a look intraday at GE, 1 minute chart. Our friend Bob Ruck called this one the measle chart. So number one, what I want you to notice are all these purple highlights. And what we're looking at is over the life cycle of GE today, the stretch from the RL270 to the peaks of the RL10. So the RL10 we think of as the real price, RL270 as the long-term fair value based on that time frame. So it's the difference between the long-term holders and the short-term traders for that particular time frame. That relationship remains constant no matter what time period we look at the chart. So this could be, the relationship would be defined as the same if this was monthly, weekly, daily, 2 hourly, etc. And this is the foundational idea of the regression line fractal framework. That's the difference of opinion between short-term traders and their price and the long-term fair value of the long-term holders. And in that tension between those two opposite positions, a trade is possible. So I want you to notice that there's a standard stretch that seems to be evident. In other words, how far the RL10 can stretch from the RL270 until one or the other starts to correct. You'll notice that the 270 does correct during the day following the trader's price, although slowly. And there's a limit to how far the traders are able to pull that big large cap stock away from its long-term fair value. So this unit of stretch, if you will, that's like how strong the bowman is in pulling the string on that bow and arrow. So get it this far before it fails, and they stretch it this far before it retraces. Here's a moment where the price and the fair value agree, and now that stretch to the far side, it goes 1 unit of stretch, and then back to the zero line, and then stretches once again. It's rather than zero line, it stretches once again down almost to that stretch, down to the VWAP where it holds. I want you to notice the next stretch up, not quite. Next one further, so that you can see that's a tell that this thing is increasing in trader power of pulling away from the fair value, and there's enough volume being traded that now, and price movement, that the VWAP is moving up and the fair value. Next stretch, next stretch, next stretch. So we can actually start using this unit of measure, this adaptive unit of measure, as a way to start estimating the length of the next move, or if it fails, the symmetrical fail on the other side. So there's one leg, two legs. The next relationship I want you to notice is the VWAP, the volume weighted average price, which is one way of measuring fair value, and the RL270, which is just a statistical price not influenced by volume. So that's a pure price stretch. And early in the day, fair value was above the 270, and then the 270 starts catching up, and then it crosses over here, and now the 270 starts to slowly pull away from the VWAP as the persistent buying and price improvement starts pulling away. It's not till right about here that you notice the 270 begin to increase as we start getting a lot more volume being traded, to the point where at item number 6, enormous amount of volume late in the day, and that's people that want to own this overnight. And at the same time, the people that are selling are the leveraged day traders who've been making their money on this on the way up. And so notice how that 270 continues to pull away. It's maintaining a pace now with that price, but it's pulling away from the VWAP, and then that's a risk premium that people were willing to hold overnight just to be in GE. So GE will certainly be in play tomorrow. All right, shifting to 3 and 4, also a combination. We're going to start taking a look at the cycling sine wave of the MACD histogram. And I want you to notice the relationship with that red Bollinger Band river. It's a 30 period, 1 plus or minus 1 standard deviation. And that crossovers outside that river start corresponding to significant moves. Crossover, it's almost like a P1 to a P1, but using the MACD instead of price. So that move corresponds with that move. Then it becomes spring, and look what we have, a nice spring move into the summer, and then the fall holds all the way through to here. And then after a brief pullback, begins to be spring, summer, fall, and now the important one right here, when fall comes back to the zero line and then resumes, that's your buying opportunity. If you didn't get any of that, you must get this one. Second opportunity after a nice move up. Third opportunity after a nice move up. So that's the pattern you should be looking for in a persistent uptrend. That MACD histogram comes down in the fall and doesn't dip into the winter, but then resumes. That's like the exhale, the pause that refreshes, and the next leg up. Extremely important. So that's 3 and 4. 5, we're just taking a look at my stack of things that I follow during the day, because my job is to find the movers. So what I was in today was GE, Boeing, the triple Dow, and Win. And so I want you to notice that UDow was up almost 2%, the big fat Dow, but triple leveraged. And the diamonds, that this is the triple leverage of, were up 0.62, while the S&P itself was only up 0.4. So the strength, the relative strength, was in the diamonds and industrials, technology, farms. That's where the strength was today. And you'll see the individual components that were really exceptional. Dow and DuPont, Microsoft, Intel, Apple, Tesla, tech companies. But now the relationship between the market, Dow is doing better, and then the triple leverage UDow is not bad. And that's what we want by item number 5. Number 6 is this, and I've already talked about that great big spike of volume into the close. I just want you to notice the standard markup on this chart. That blue line represents the open, and the red line represents yesterday's close. So that actually measures the gap, and then it's not surprising when that acts as a support level through the day that that's the direction that the market is voting. So that's why I pay attention to that region during the day. So that's the daily quiz. If you just hold on a second, I'm going to take a quick look at the daily report. Just take a quick look in here. The market condition, I've replaced that regression channel with the daily range as a yellow zone, a 10-day, and then a 30-day trading range. You can see where we are inside of this. This is an enormously strong 30-period move. That regression, that moving regression line, we're going to see just how strong that is. This is the place where they came out of the river, where the 30 comes out of the river. That's the beginning of trending behavior. But notice the P1, the RLXD, price close over the dragon, and owl right about here. So plenty of things to look at. And now testing this emerging dragon in the 200 period moving average, and we're just past fair value. That's the first leg back. If you look at micro legs, that's 1, 2, 3, but that forms one big leg, and so now it's a retest of the higher high. Winter, spring, enters the river, exits the river, summer, and now just testing fall. That's not bad. All of the indexes are screaming potential shorts, so that makes this a really problematic move. The volatility is still holding at 2 sigma on the quiet side, favoring the long swing. But the length of this 30-period move has got my attention. Lots of dojis today. Dow, Boeing, GE were the big winners. Boeing, noticed that great big breakout on every time frame, and the great big breakout in Nike. ETF tactical, Lots of breakouts in here on all the big broad indexes on the 10-day and 1 month. Everything's near its 10-day high, so you're not getting any kind of auto framers. The most positive Z stretches, Boeing, GE. The widest rivers, Boeing, Goldman, Diamonds, the S&P, the Russell. Almost 2 sigma is how wide and directional that river has become. Only treasuries are very tightly pinched. Several in the auto framer, McDonald's, Verizon, DuPont. That's one to certainly look at. Lots of daily squeezes, so that loss of volatility compared to the range stat, that's typical of this kind of condition where we had large range days giving large volatility and then starting to narrow, thus creating a pinch opportunity for one-day pops. Most everything in the spring and summer, we get some rolling over into the fall. I would be looking for resumption of these trades, though. Verizon and Pfizer in the winter, so some deep value plays there. I want you to just notice how steep this is. The best 30-day slope up in the last 10 years. That's how strong this move has been. It's that slope stat at 3 sigma. Period slope stat, and now the 90 is really starting to recover after that huge spike down. This is the resistance we've got to clear, and the all-time high is just right here now. Pause, it refreshes. I'd be looking for support at the edge of the river, but we want to preserve gains that we've made in here while remaining open to the possibility of continued gains. I interpret this, although the 90 is improving, it's still at minus 3 sigma. That's how bad that has been. And so the market is still aware of how painful this was. Although this has been nice, more people, I think, are looking at this as resistance, and that's all-time near high. I'm beginning, my spider sense is beginning to whisper, preserve profits. That's what I wanted to highlight today. So take good care. We'll see you in the chat room.